Hi, welcome to the CFO channel. In this video, we'll cover an overview of the cash flow statement, and then we'll take a look at Apple's cash flow statement to understand the different components of cash flow. All right, so when it comes to the cash flow statement, it's my favorite set of financial statements. When you look at a cash flow statement, what it tells you as a reader is how much cash a business made during the course of a year. How does it do this? It basically looks at the cash balance of a business at the beginning of the year and the cash balance at the end of the year. And the cash flow statement basically links that beginning balance to the ending balance by showing you all of the movements in cash during the year. A very good illustration of this is if you look at your own cash balance. So let's say in January of 2021, you start with a cash balance in your bank account of $50,000. And then as the year progresses, you find yourself in December 2021, on December 31st, 2021, with a cash balance of $70,000. What does this mean? It means you made $20,000 of cash during the year. Another way to think about the cash flow statement is that it links how profit is converted into cash that is sitting on the company's balance sheet. If this sounds a little bit confusing, don't worry. We'll go through Apple's financial statements to look at what this exactly means from a real world perspective. All right, so here is Apple's cash flow statement for the most recent fiscal year ended September 25th, 2021. The cash flow statement essentially has three sections, which I'll cover shortly. However, what I'm interested in telling you is if you go all the way to the bottom, you can kind of see what I mean by showing the movement in cash. So last year, Apple had finished the year with cash of 39 million, right there at the bottom. This year, it finished the year with 35 million, so 36 million actually, if you round it up. It basically, you can kind of see the 39 million was depleted, was basically decreased by this amount here, about $4,000 to reach to that 35 billion number. So essentially, the cash flow statement basically illustrates how these two numbers move. Cash on the balance sheet at the end of the year versus in 2020 versus cash on the balance sheet in the current year, so for the year ended September 25th, 2021. Now, if you look at your cash flow statement, there are really three main sections. That is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So for the rest of this video, what we're going to do is dive into each section to understand what each section means. Now, the first section, and usually the section at the top of a cash flow statement, is something called cash flow from operations. This section shows you how much cold hard cash a business made during the year. This is basically all of the cash that a business made from its day-to-day operations. That is selling products and services to its customers and going about its business. It doesn't include any type of related asset sales or anything that doesn't pertain to its day-to-day business. It also doesn't include things like money you've raised from investors, money you've received from the bank, or money you've paid to your investors or paid the bank. These are covered in separate sections of the cash flow statement, which we'll cover next. And more importantly, what you're able to do with the cash flow statement is see how profit is converted into cash flow. Now, if you remember our last video, which I'll link somewhere on the screen here, cash flow and profit are not the same thing. What the cash flow from operations section does is it starts with profit at the very top, and then it converts it. So it adds and subtracts all of these items that are non-cash, included in profit or excluded from profit, and then essentially comes to a number that is called cash flow from operations to tell the reader, you as a founder or an investor, how much true cash the business actually made during the year. Now, if you look at the cash flow from operations section on the cash flow statement, you're really making three main adjustments to profit. What you do is, the first adjustment you have to make is basically remove any expenses that were expensed on the profit and loss statement, so on your income statement, that actually didn't reduce cash. So one of the common ones is depreciation. As you recall, depreciation is essentially what you do when you buy a capital asset. You put it on your balance sheet and then you expense it over time. When you're expensing this over time, over a few years, it doesn't necessarily match cash because for cash flow purposes, when you buy a capital asset, all of the cash leaves the company when you buy the asset. There's no such thing as depreciation for cash flow purposes. So that's the first adjustment you have to make, is essentially remove any expenses that were non-cash that went through the income statement. Number two, the second adjustment you're making is basically adding and removing any types of gains and losses that are not related to the business. So think about a capital asset that you bought a few years ago that now you're selling for a gain because it's appreciated in value. Any type of gain or loss that is not related to your core business, what we do on the cash flow from operations section is basically remove those items. And then the third thing you're adjusting the cash flow statement for is working capital. So think about things like inventory, for example. When you buy inventory, accrual accounting tells you to take that inventory and capitalize it on your balance sheet. So what are the implications of this? Cash flow went out the door because you had to buy the inventory. The inventory wasn't expensed, so your expenses are understated, which makes profit look higher than it actually is. So what you do on the cash flow statement is that you actually adjust for this. Because profit is artificially higher than it's supposed to be, what the cash flow statement does, it says, hey, this cash actually went out the door, so I need to reduce profit by the amount of cash I spent on inventory. This is one of the most common adjustments that you see for a lot of inventory related businesses. I'll actually do a completely separate video for working capital because it merits its own discussion. And now we'll take a look at Apple's cash flow statement once again, and we'll focus on the cash flow from operations section of the statement. So here is Apple's cash flow statement, and now we'll focus on the operating activity section. So like I said, you can see they start the statement by taking profit, making all of these adjustments here to then get cash flow right here, which is 104 billion. Apologies for my crappy drawings. Some of the main adjustments that they're making to profit, you can kind of see here. There is depreciation. Again, this is a non-cash expense that they're adding back. So what this essentially tells you is depreciation was recorded on the income statement. It was expense on the income statement, so it reduced profit. Therefore, we added back to increase profit to what it's supposed to be for cash purposes. There are all these other adjustments as well that they're making. And the other key adjustment that they're making as well on the statement of operating activities is all of these working capital changes. So these are basically changes on the balance sheet items. So you can kind of see here, inventories, for example, it looks like Apple bought more inventory if you compare 2021 to 2020. And just so that we can kind of see what the implication of this is really, let's take a look at the balance sheet. What we should see on the balance sheet is basically the inventory balance increase from 2020 to 2021. So let's go there very quickly. Let's find inventories. So if we look at inventory last year, about 4 billion. This year, 6.5 billion. There you go. So that makes sense. So obviously what Apple did in this case is that they bought more inventory, which is why you see that there is a cash outflow in the business for 2.6 billion because they purchased more inventory during the year. Now, the next section on the cash flow statement is called cash flow from investing activities. This section essentially shows you how much cash was spent on things like buying capital assets. That's like a building, equipment, a truck, stuff like that. Number two, it also shows you how much money was spent to buy other companies, so M&A type activities. If Apple, for example, buys another company, this is where this would be shown. Number three, it also shows you any other type of long-term investments that the company is making. Essentially, the way I would think about the investing section is it's the company's investments, long-term investments that the company is making that aren't related to its day-to-day operations, which are covered again in the cash flow from operations section. Now we'll take a look at Apple's financial statements again to see what the cash flow from investing section looks like. All right, so we're back on the cash flow statement for Apple. Let's take a look at its investing activities, which are right here. As you can see, like I mentioned, there are really three main things to pay attention to here. There's the money that Apple spends on acquisition of property and plant equipment. So this is any type of buildings, equipment, etc. that the company is buying. You can tell that they spent about 11 billion in 2021. The payments made in connection with business acquisitions. So this is any type of M&A that the company did. So they spent about 33 million, so not much in acquisitions. And last but certainly not least, there are all these other investments that Apple makes in marketable securities. So these are basically marketable securities. You think about investments in stocks, bonds, etc., etc. Because Apple has a lot of cash sitting on its balance sheet, Apple likes to take that money and basically invest it in securities to make some sort of a return. You can see here that they sold some securities. So this is a positive cash inflow. So this is money coming into the company. And it looks like they took most of this money and they actually invested it again. So that money went right out the door at about 109 billion. So these purchases for marketable securities are again like investments that the company is making that aren't related to its day-to-day operations. Now, the last statement of the cash flow statement is called financing activities. This is the section where a company basically shows how much money it received and paid to its investors, equity holders, and debt holders. This section essentially covers three main things: the money it raised from its investors. So doing things like an IPO. If a company does an IPO, you'll see a mass cash inflow coming into the company in this section. Number two is any type of payments that the company makes to its investors. So let's say a company pays dividend payments. You will see those dividend payments in the financing section. And number three would be any type of money that the company gets from a bank. So let's say the bank gives the company money. That money will be a cash inflow into the company, and you will see that cash inflow in this section. And vice versa, if a company has to repay a bank loan, you will see that repayment of that bank loan in the financing section. Essentially, all of the items in the financing section don't pertain to the day-to-day operations of a company. They don't pertain to any investments that the company is making either. This is essentially money coming in and out of the company from its equity holders and debt holders. You can think about this section as how a company gets funded. How does it actually get money in order to be able to do its business, run its business, expand, grow, etc., etc. A lot of those financing components of how a company grows essentially are shown in this section. It also covers how shareholders, the owners, essentially pull money out of the company for their own benefit. Okay, so looking at Apple's cash flow statement once again, we go to the financing activities, and it is here that you see those few key items that I just mentioned. You see any proceeds from issuance of common stock, so any equity they've raised from their investors. Apple raised $1 billion in 2021. Any type of dividends they've paid to their shareholders, including any share buybacks. So you see that here, 14.4 billion and 85 billion for that. And then any repayments to their debt holders. So you see this under repayments of term debt or any type of debt that they've recently brought into the company. So this is new debt that Apple has. It's proceeds from issuance of term debt. So this is debt coming into the company. This is repayments of debt for 8.7 billion. And that is financing activities on the cash flow statement for Apple. All right, so I hope that was a good overview of the cash flow statement and you learned something. We drop weekly videos every Sunday, so be sure to subscribe.